Hey guys, and welcome to another episode. So, in today's show, we're going to talk about why you need to start investing in the banking stocks. So, if you have not considered or even have the banking industry, the banking sector on your radar, I'm going to go through a few reasons why you definitely need to really consider and start reassessing and just having these industry in your portfolio. So the first and most important one is that interest rates have finally started lowering. So it's the second time for this year that interest rates have started lowering. And if you're not familiar, commercial banks really make their money during low interest rates periods. And this is really because when interest rates are low, persons tend to borrow a lot more. And so when persons borrow more, this really impacts the economy, impacts the country. So when interest rates are high, borrowing becomes less, and banks tend not to make as much money as they would during other low interest rate periods. And this is really because commercial banks make their money by using the savers money. That is, you would open a savings account or a fixed deposit account and you put your money in it and they lend it out to the borrowers. Now, if persons are borrowing a lot less, then they'd have less money to lend out, and so they won't be able to earn as much on these funds, and so the funds would now become put aside, and they'd have to put it in other assets that would be approved by the SEC and the Fed so that they can store their funds in. So when it comes down to commercial banking and interest rates, now when interest rates are high, these commercial banks have to find other ways of making money. And so if you realize when interest rates are high, you tend to notice that fees is the first thing that becomes more expensive. And you also notice that new fees are being introduced. So if you have a bank account and you didn't pay much fees on the account, you'd notice that during high interest rate periods, they would start introducing some newer fees. And so with this, the banks really have to find other ways to earn and to pay their staff and the workers and to generate profits and to keep afloat. And so if borrowing has become significantly less in the economy, then they need to find another way to make money. And so they do this by increasing fees and implementing new fees so as to really keep the business afloat and try to make profits as much as possible. So the second reason why you need to consider banking stocks is that inflation rate is low now. So it's currently at 2.6% and it has been below 3% for the last few months. And so with inflation rates now being more stable and closer to the targeted 2% that the Fed wants, it now allows for consumers to be able to really understand and what is happening, and in terms of the rising prices of goods and services, it should now be stabilized. It should start being reduced as inflation has been reduced. Now, it might not be reduced instantly, but over time, you should start seeing that the cost of these items would not be as rising as much as they did over the past 2 years. And so with that, the markets would tend to open up a little bit more. They would be freer. And with President Trump now winning the seat to become the next president of the United States, one of his policies is that he is going to tackle inflation. And so with a commitment like that, with a statement like that, he is going to deliver in terms of keeping inflation low and getting it to that 2%. And it's kind of ironic that the day after his win was announced, the Fed decided to cut rates for the second time. It's a bit ironic, I would say, because they could have reduced it so many other times and they chose to wait. And who knows, maybe that was their reason for waiting. Maybe they have a lot more faith in his administration over the current one. Who's to tell? And so with that, he also stated that he's going to reduce corporate taxes. And so corporate taxes is one of the most expensive taxes that any business pays. As Robert Kiyosaki always says, the government tells you what they want done with the tax laws. So if they want to develop a certain area, then they'd reduce or give you tax breaks to implement or develop that area. And if they don't want the resources going into a particular area, then they just tax it. And so it's very simple, very straightforward. And that's what I love about Robert Kiyosaki. He just tells it as it is, straightforward. And it is so true when you look at it, because if the government really needs an area developed or they need persons or expertise, they are going to give you tax breaks. So if there is a housing crisis, for example, they give tax breaks for development, and so more companies would start developing. And if persons need jobs, they probably give you tax breaks for hiring a certain type of worker, certain skills, certain amount of workers. It really is just there. It's in the law. So for more information, you can check the tax laws as to what areas there are breaks in and what others there aren't, or speak with an accountant or a lawyer. And so another reason why the banking industry is set to grow, right now the Dow Jones banking sector index is up 0.15% over the past day. So over the last 24 hours, it's up 0.15%. The S&P 500 is up 0.03% approximately. And the NASDAQ is down 0.26%. And so what this really is saying is that persons are having a lot more faith in the banking sector and the banking industry. And if you also look at the indexes over the past year, the Dow Jones banking sector index is up 36%, while the S&P is up 26%, the NASDAQ is up 30%, and the Dow Jones is up about 21%. So what does this really say is that the banking industry, the banking sector, is where investors are perceiving their next growth and the next best opportunity for their funds. And if you look at individual stocks such as Wells Fargo, you look at American Express, you look at Discover Finance, these stocks over the past year are currently up over 25%, every single one of them. And why would you not want to get into that industry where it really struggled and it really suffered since the pandemic came? And over the past 2 years, this industry and this sector has really struggled, especially with high inflation, high costs, high interest rates. And now that it has been lowered twice within the past less than 6 months, and there's a change in government that investors are now favoring and the market is now favoring. And if interest rates continue lowering, then it's only a matter of time before borrowing starts to increase. And with borrowing increasing, persons are going to want to purchase more houses, more cars. And so it's really just going to trickle down until it stimulates the economy. And that's really what the new president really wants to do. He wants to stimulate growth and development in the economy. And if he can get inflation low, interest rates low, he can get persons to start borrowing again. If the mortgage rate starts falling from the current 6% that it's at to even 4 or 3%, then the amount of persons that will start investing, will start borrowing again, will increase significantly. And development companies will also start seeking more development loans, which will increase housing, increase plazas, increase just different types of properties and different types of land. And so these really will over time trigger and stimulate the economy. And the last thing that I want to say is that earlier in this year, there was talks of a merger between Capital One and Discover Finance. And immediately it sent the entire world, the entire markets in a frenzy. Stocks jump. And then shortly after, the Biden administration had kind of pushed back. They had started putting up roadblocks, and they shared that they would give this merger a much hard time in going through. And this is because the Biden administration is more conservative, and so they are of the view that if they approve this merger, then it would really become more monopolistic in the market, and they would have more control and the competition would be less. And that's one way to look at it. But the other way to look at it is that right now the leaders in terms of cards are MasterCard and Visa. They're the leading credit card companies in the world. And so if Discover and Capital One merger actually goes through, they will become the largest debtor in the nation. So what that means is that they will have the largest amounts of borrowers on their books for any US company, I should say. So what that really means is that with all the different banks right now, the credit card agencies that persons are currently using, with Discover and Capital One merging, it would really take them above MasterCard, Visa. And so they would also be likely to be more accepted internationally, and they would definitely give MasterCard and Visa much challenge, because right now it's practically a duopoly in that credit card space. And so with a third person entering the field, it would really drive more competition. And so vendors and merchants alike would now be able to state what they want, share their needs, and the best way that economy or persons can share what they want is by moving their business. So if you are offering a service and there's no alternatives, person will stay and be very disgruntled. But the minute a competitor enters the market and they offer something more attractive, something much closer to what they want, they're leaving you for that competitor. And so if Discover Finance and Capital One merger is approved, then definitely MasterCard and Visa will need to reassess their business model, because at least the US markets will start shifting based on how that whole sector is currently running right now. And so that's really all I wanted to share with you guys today. So if you like this video, I just ask that you give us a thumbs up. If you have any questions or comments, feel free to share it down below. And subscribe to the channel so that you don't miss out on any new episodes as soon as they are launched. Alright, take care. Love you guys. Until next time. Bye.